Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include a little check on tappable home equity, my interview with American Bankers Association's Rod Alba on disparate impact and how we can get to a place of better regulation from Washington, D.C. And in the capital markets, it's kind of all quiet on the Western Front, though we do have a packed week of data and happenings ahead of us. Thanks to today's podcast sponsor, nCino, makers of the nCino Mortgage Suite for the modern mortgage lender. nCino Mortgage Suite's three core products, nCino Mortgage, nCino Incentive Compensation, and nCino Mortgage Analytics, unite the people, systems, and stages of the mortgage process. See how nCino can support a homeownership journey that your borrowers and your team will love at ncino.com. At what point does extreme weather become commonplace and the public immune? The roller coaster of weather within the nation continues. Just ask the rain-drenched East Coast, now roasting, sun-baked West, and flood-impacted Texas. The same with real estate values. Places like Florida, Phoenix, and Las Vegas are subject to violent swings in supply and demand and price roller coasters. Unfortunately, for homeowners in Las Vegas, it appears that they're in a downdraft. LOs took note when ICE Mortgage Technology estimated that, heading into the second quarter of 2025, U.S. mortgage borrowers held $11.5 trillion in tappable home equity, or equity available for borrowing while maintaining at least a 20% cushion. Meanwhile, investors are snapping up a growing share of U.S. homes as traditional buyers struggle to afford one. The headlines this morning are revolving around the U.S. and European Union agreeing to a hard-fought deal that will see the bloc face 15% tariffs on most of its exports, including cars and liquor. Speculation around Fed Chair Powell's replacement, or potential replacement, has quieted for now, but this week's Federal Open Market Committee meeting could reignite the conversation, especially if markets start pricing in more 2026 rate cuts based on expectations of a dovish Trump-appointed successor. While the Fed ideally bases decisions on data and economic forecasts, the prospect of a more accommodative future chair could complicate its calculus, potentially pressuring current members to ease policy preemptively to avoid market disruption. For now, the FOMC is expected to keep rates steady, but Powell's post-meeting comments will be closely watched amid growing political pressure from President Trump to lower rates. This should be the busiest time of the year for the housing market. Instead, simultaneously, sales are down and home prices have hit a record high in many parts of the country. For today's interview, I wanted to welcome to the show American Bankers Association's Rod Alba to talk about disparate impact and how we can get to a place of better regulation from Washington, D.C. He's Senior Vice President, Mortgage Finance, and Senior Counsel at the American Bankers Association, and his role obviously includes management of legal and regulatory issues. He recently released a white paper on disparate impact, which I wanted to have him on the podcast today to talk about.
I wanted to talk about this disparate impact white paper, and you're obviously a lot more well-versed on it than I am, so maybe let's bring the audience up to speed a little bit about the kind of reasoning behind writing it, big takeaways, and what you think it means for the industry in general, the findings.
So thank you. The white paper has been put out basically to describe in more detail the ABA's efforts and policies towards disparate impact and the disparate impact analysis. And really, it's an effort to correct what we believe are, have been certain missteps by previous administrations in enforcing fair lending and enforcing, in particular, disparate impact. We are, the American Bankers Association, along with the rest of the industry, is very committed to fair lending. But if not done correctly, or if done under rules that don't necessarily fit either the authorizing statute or Supreme Court precedent, Robbie, it can get very ugly, and it can actually hamper lenders and banks from serving their communities. So that's what we're aiming to do with that white paper, is to lay out and to describe exactly the legal premises and what the correct application of the law should be.
Can you kind of bring us up to speed on what the interpretation was, maybe how it was incorrectly interpreted in previous administrations, the current interpretation, kind of big findings?
Yeah, yeah. So, let me try to keep it very simple because, even experts get confused when you start throwing out big words. And I think that there's so much, it's a bit of a ping pong game sometimes when you start talking about this because there's multiple elements I think that matter. I think that disparate, fair lending, of course, is that you can't discriminate on the basis of certain characteristics, including race, national origin, sex, etc. I think we're all straight on that. The concept of disparate impact is, what happens when you're not necessarily discriminating or intentionally discriminating, but the outcome of your lending patterns reflect that there may be, let's just use race, that there may be racial imbalances, right? So it ends up at the end of the year that you only made 50 loans to, let's say, the Black community. However, you made, 550 loans in the white community. How does that pair up? And certainly, what happens when you have that disparity? And at that point, then is that actionable? And it's interesting. I think if applied correctly, I think that disparate impact analysis, Robbie, is very useful. I think as a matter of ethics and as a matter of being a good citizen in your community, you should know the impact of your lending within your populations. You should understand how it is that your lending is distributed. But that doesn't mean that when there is an imbalance, that you should be held or that you would be held guilty of discriminating. And so it's succinct, but it's very real. And I think that we've seen cases, in particular in the last administration, where just mere imbalances were leading banks and were leading lenders to being accused of discrimination. Robbie, to your precise question, the Supreme Court, in a case that is referred to as inclusive communities, which is the Texas Department of Housing and Community Affairs versus inclusive communities. This was a 2015 ruling. In effect, let me give you the two things that matter. The Supreme Court confirmed that claims based on statistical disparities alone must fail. Okay? So you can have a case, an enforcement case, or a civil case that is brought on statistical disparities alone. Very important. And second, that the plaintiffs have to satisfy a robust causality link by having a policy, by pointing to a policy that is leading to the disparity. All right. So those are two very important points. And I think that it's points that perhaps have been overlooked as we look at several cases that have occurred over the past several years, which is you can't just simply bring a statistical disparity and say, hey, you lent more to Hispanics than you did to Asians in your community, and therefore you're discriminating. No, no, no. Statistical disparities alone cannot form the basis or the entire basis of a claim. And again, to the extent that you do make an accusation of disparate lending, then you have to point to to something that is causing that. You can't just simply assert that there is a disparity or that there is an imbalance. So we're attempting to say to our policymakers that you have to incorporate these concepts into the rules, into the laws, and into the guidelines for fair lending enforcement and oversight. I think that your audience will surely appreciate those two points. It's much more complex in certain respects, but Robbie, it's as simple as the 2 points that I just made to you.
Yeah, I was going to say it's almost frustrating to hear some of the ways this was adjudicated in a sense previously, because mortgage lenders out there would tell you look, loans aren't falling from the sky anymore. I want every single loan I can get. And to think that I would discriminate or try and have different, disparate impact to my community is just ludicrous. And so, to a degree here, has some of this been remedied by the new administration's more lax oversight actions or desires? How much of it has been remedied just naturally by some of what the Trump administration has brought into play when it comes to enforcement?
Well, at current, I think that the current administration has basically eliminated any sort of policy that is based on disparate impact analysis. So it just issued an executive order, that is Executive Order 14281. And that executive order basically says that all agencies have to review and potentially repeal regulations that involve disparate impact. So, don't expect to see it coming from the administration, but certainly this, disparate impact lawsuits can still be based on, could be brought by private plaintiffs. And don't be surprised if after the current 4 years and when we get a new administration in place, that they may again reimpose disparate impact, and they may bring actions, including actions based on activities that are taking place now while we're under the executive order just issued by Mr. Trump. These things tend to last into the future, and certain administrations have been known to look backwards and pick up previous sort of faults and sue on those faults. So we have to be careful.
In general, what has the response been to the white paper versus what you hoped its intended effect would be?
I think it will have an impact in that it provides a careful and detailed description of the legal issues that we're talking about. So you and I are talking generalities here. And I think that when you pick up that white paper, it gets into the detail as to the whys and what did the Supreme Court say, and it compares that to the HUD rule, the Fair Housing Rule, and it compares it to the Equal Credit Opportunity Act, and says, here are the places where the law has to be tweaked and changed in order to comply and comport to the Supreme Court ruling, Robbie. So I don't think that you're going to see everyone talking about it, but you will see it being quoted and discussed in the policymaking area, where I think that the legal details matter.
Yes, and I do try and stick to generalities here for the sake of this podcast because it's meant to be a holistic look at the
Mhm.
industry. If this was a targeted legal podcast, we could dive into a lot more of the minutia. However, I will give you the platform here and ask you, is there any minutia that you think is very important for the general mortgage public to understand that's worth discussing in this interview?
Two or three things. I mean, I think one of the things that's always discussed is, why does this matter? And it certainly matters for liability to lenders across the spectrum. And it also matters, Robbie, because it does influence what we do. It affects how we lend. It affects how we interact with our own community. All right. So let me give you a very simple example of this. We have a very diverse country that has become even more diverse with the immigration coming in, right? We all acknowledge this. So, how do you serve a community that is composed of, for example, Spanish speakers, French speakers, and Chinese speakers? You're looking out at your own community and you want to bring them services in their language. Is that discrimination if I, for example, bring, offer my disclosures or my advertisements only in Spanish? Because let's say that of all the foreign-born people within my region, 60% of those are Hispanic. So what if I just bring it to them in Spanish? Is that disparate impact? Well, certainly if you just apply the rigid regulations, or you look at this at this law in accordance to how previous administrations have been looking at it, of course it is. When you're sort of putting out your ads in Spanish, that could count as discrimination because you're leaving out certain populations. Now that's very negative. It means you can't even start down the road of serving their communities in the way they want to be served. I'll give you another example. Let's say you're trying to do the right thing, Robbie. You're saying, wow, we have a population of, let's say, African American. It's an African American population where we must serve it. We must sort of focus our attention to make sure that they get the loans. We see that they have a lower proportion of loans than others. So you start to up the advertisements towards that community. Can that be deemed to be a violation of the disparate impact concepts and enforcement provisions that have been on the books? What happens if I start to focus on that community? I put a lot of people submit a lot of applications based on the advertisements that I did, but since the applications went up, it also means that I will be denying more loans simply because I was successful in advertising to that group of people. Yes, I mean, you could be viewed as violating the laws under sort of loose application of the disparate impact law. So this matters. Everything that you do as a lender sort of happens within your community setting, and your community setting is sort of divided among, various and multiple protected classes. So getting the disparate impact rules and regulations right really matters. And I think that that's the point, is that as we engage in this conversation now under the Trump administration, hopefully we can put this into balanced and rational regulations that will span the time into future administrations as well.
Yes, and I don't want to beat a dead horse necessarily, but I think people in the industry can agree that, in the mortgage industry, can agree that we don't necessarily need more regulation or even less regulation to a degree. We need better regulation. And so, what's your hope for what this discussion that this paper has engendered will lead to in terms of better regulation? And I know you answered that in a way last question, but like, what are you hoping for specifically when it comes to disparate impact? Some future regulation, either new stuff or tweaks to it, or what's kind of a pipe dream for you?
Yeah, so, very good question. Certainly, number one, I always say this with some amount of frustration. By God, it's 2025, and we still don't know what discrimination means in America, right? I mean, stop and think about that. Stop and think about the fact that the redefinition and the jiggling around with the details of this law lead to confusion, and we're not sure in many instances what discrimination means in any particular setting. That has to be remedied, Robbie. We have to know. We have to understand. It's fair to lenders, it's fair to us, and it's fair to our communities. And policymakers should understand, how this law is applied in order for them to make better decisions. That's certainly number one. Number two is that there is a fair use to disparate impact. It is an analytical tool that can be used, that should be used. And certainly depository institutions that I represent at the American Bankers Association, we measure this. We have to look at this. We have to look at the HMDA numbers. We have to look at our at our dispersion of loans and how we're lending and to whom, because we have to serve our community. So we have to be able to use these tools without them being used against us unfairly. So to a large extent, I think we want to preserve its value, and we want to completely kill the unfair application that often is used for political purposes, or sometimes just to strong arm institutions into paying more monies for X or Y reason.
And I want to zoom out here slightly to give people more context about the ABA, because obviously most people on this podcast are familiar with MBA, or the Mortgage Bankers Association. When it comes to the ABA, can you give us kind of a Venn diagram of how it operates in a completely different sphere than the MBA, but then also some of the overlaps that are out there?
Yeah. Yeah, we're brother and sister. Okay. The American Bankers Association and the Mortgage Bankers Association sort of act in tandem on most issues that affect mortgages. As a matter of fact, I'll tell you, I used to work at the Mortgage Bankers Association doing regulatory work. So I was a regulatory expert there at the NBA for a long time, and it's work that serves me now, and it's work where we continue to work together with the NBA in every way. But we represent depository institution. We represent banks. We do not represent independents. Okay, so independents, IMBs, independent mortgage bankers, those institutions belong to the Mortgage Bankers Association. However, there are many banks that also belong to the Mortgage Bankers Association because they lend mortgages. And so we share a lot of our membership. And you will note, for example, that some of the larger institutions, such as Bank of America, let's say, JPMC, Truist, et cetera, some of these large institutions belong to both. And so we operate in tandem. The ABA, the American Bankers Association, does a lot more than mortgages. So we also do deposits. We do, all sorts of safety and soundness oversight that some of the IMBs may not have or have only at the state level. And so we sort of holistically cover a lot of the banking issues where the MBA really focuses on mortgage lending only.
And finally, before I let you go here today, next steps from this, or are you on to the next thing out there, kind of priorities for you, either from this white paper or other issues that you're looking to tackle here in the near future?
Oh, no, we have quite a lot that are set up that, we're setting up for reforms. There's a lot of things that need to be fixed, Robbie. Fair lending is one of them. But certainly look at, for example, TRID. TRID continues to be a massively confusing regulation where the costs are always high in terms of implementation. We don't, one of the things that we are looking at, for example, is how can we fix the whole tolerance system for under TRID. It is absurd to tell lenders that they have to absolutely guarantee the fees and the prices to the applicants only 3 days after they apply for a loan. Nowhere in the legislation does it say that. It makes no sense to have lenders promise and actually guarantee to the consumer that third parties will only charge you a specific amount. Right? It shouldn't be within our purview. And, these things sort of create massive confusion within our shops, within, in the compliance. They create huge costs to consumers because we have to increase our costs and we pass that on to the customer. And this is at a time when we're actually trying to lower costs and make loans more affordable to consumers. The other big one that's coming up now is the yellow compensation rule. How do we sort of get it straight that we understand that there may have been certain abuses in the past, but the whole proxy test, for example, under the yellow comp regulations, it's confusing and it doesn't make sense. As a last example, I'll give you the language preference question that you have when you are providing loans to consumers. You have to ask them what language they prefer to do the loan transaction and the loan negotiation. And this is very uncomfortable for many consumers. They don't want to necessarily give you a language. They don't understand why you're asking these questions. And by the way, these are questions that then sort of feed into the fair lending risk that institutions have, because now the consumer is explicitly telling you that I want to do a transaction in a particular language. What exactly does that mean? Because it's not being collected by the government only to have statistics on it. It's actually being sort of accumulated, and these are going to policy decisions. So there's a lot of elements I think that are on the table that we can straighten out for the better of consumers and certainly for the benefit of lenders as well.
Yes, it's certainly encouraging. Your passion for wanting to help out consumers, lenders, bankers, all sorts of entities, even the government, get to better regulation. We all want to get to a better place. So I appreciate you making the time for me. I enjoy having you on the podcast, and best of luck with this and other endeavors going forward, Rob.
Yeah, thank you, Robbie, and thank you for all you do.
This week is packed, both on the economic calendar and in terms of market moving potential. featuring a flood of corporate earnings, major economic data releases, and central bank decisions. Investors will parse quarterly results from tech giants like Amazon, Apple, Meta, and Microsoft, alongside reports from 9 Dow components. The Federal Reserve's 5th interest rate decision of the year headlines a busy central bank calendar, and they'll be joined by the Bank of Canada and Bank of Japan. All 3 I just mentioned are expected to hold rates steady, though the Fed may hint at a possible September cut. On the economic front, key data this week include July's non-farm payrolls report, Q2 GDP revisions, June's core PCE inflation gauge, plus updates on housing, consumer confidence, job openings, and employment costs. Treasury auctions total over $213 billion for the course of the week, while President Trump's visit to Scotland and meetings with European leaders could carry geopolitical implications. Today is all about Treasury supply, and will be headlined by auctions of $69 billion of 2-year notes and $70 billion of 5-year notes. The lone data point is Dallas Fed Texas manufacturing for July, due out later this morning. We begin the week with agency MBS prices unchanged from Friday, the 2-year yielding 3.92, and the 10-year yielding 4.39 after closing Friday at 4.39%. Let's wrap up with a joke and some housekeeping. I hate it when I see an old person and then realize we went to high school together. Thanks again to Encino, makers of the Encino Mortgage Suite for the modern mortgage lender. Encino's 3 core products, Encino Mortgage, Encino Incentive Compensation, and Encino Mortgage Analytics, unite the people, systems, and stages of the mortgage process. See how Encino can support a home ownership journey that your borrowers and your team will love at encino.com.